Okay.
Can you hear me, Manon?
Yes, now I can hear you.
Okay. I can't seem to start recording.
That's okay, I got it.
Okay, perfect. All right, thank you all for joining me today for a review of the CARES Act and the FFCRA, which seem to be front and center these days since the pandemic began in early 2020. So again, a little bit of housekeeping. Just remember, to receive your RCH credit, you must have already checked in with your first and last name to let us know that you're here. And then as I have polling questions come up throughout the presentation, please type your answer as well as your first and last name into the chat bar with each of your responses so that we can get those recorded appropriately and get the RCH credits distributed. So thanks, Manon, for heading that up. And just a little disclaimer. The information presented in these materials and that is further provided by the presenter himself should not be considered legal or accounting advice and should not substitute for legal, accounting, or other professional advice in which the facts and circumstances may warrant. We encourage you to consult legal counsel as it pertains to your own unique situations and/or with specific legal questions you may have. So a quick agenda, we're going to review the Families First Coronavirus Response Act, or as we all like to call it, the FFCRA. We're also going to review the Coronavirus Aid, Relief, and Economic Securities, or the CARES Act. Then we'll do a little bit of putting it all together and what it means for everybody to look at both of them at the same time. And then I did throw in a little bit of information about the payroll tax holiday, as that's kind of a hot topic right now, even though it's not directly related to the FFCRA or the CARES. So that's what we will do today. If you do have questions, if you want to go ahead and type them into the chat, Manon can holler at me if she sees a question that I can answer at an appropriate time. So with that, let's get started. So first of all, what prompted the FFCRA and the CARES Act? And obviously that was the coronavirus, or the COVID-19 crisis, has spurred legislation and guidance to combat the shutdown of the economy and high unemployment that has come about since the coronavirus pandemic hit the United States early in 2021. So first of all, we've seen a lot of changes in the workplace. Whether you work in an office or whether you work in a restaurant or something like that, things are different based off of COVID. So for those of us that work in an office, this may have been a setting that we were used to back in January or the end of 2019. And these days, many of us look more like this when we're working from home with maybe dogs next to us or kiddos that we're dealing with on laptops or home workstations versus being in the office. More changes in the workplace. Similar to how we're sitting today, we maybe used to have meetings that were in person. I know Becky had mentioned that we have had kind of an interesting start to this APA chapter because we haven't been able to actually meet in person. So COVID has required us to go from meeting in person, maybe in the office, to having virtual meetings where we're all sitting around like we are today, possibly on camera instead of in person with each other. So that's, prompted a lot less makeup wearing and hair doing, at least on my end, for when I'm working at home. For those people that maybe don't work in an office, they have seen much bigger changes, and that's kind of where FFCRA and CARES were more focused. Was focused on those employees who actually physically lost their job because their places of employment had to close due to the COVID-19 pandemic. Employees got put out of work because their employers could not be open anymore due to state mandates, federal mandates, things like that. So that's kind of where we start in getting into the FFCRA, or the Families First Coronavirus Response Act. This act was originally passed by the U.S. House of Representatives on March 14th, 2020. An updated version was passed on March 16th, 2020. It was passed by the Senate on March 18th, 2020, and it was signed into law on March 18th by President Trump. So the intent of the FFCRA was to help the United States combat the workplace effects of COVID-19 by reimbursing American private employers that have fewer than 500 employees with tax credits for the cost of providing employees with paid leave taken for specified reasons related to COVID-19. So employees were going to have to be out of work. And those reasons may have been because they were sick, may have been because there was a family member sick, or it may have been because their child's school had been required to shut down and they no longer had a place for their child to go during the day, so they needed to be home to care for that child. So many reasons came about from the coronavirus that employers were required to take time off of work. And what the Families First Coronavirus Response Act did is it gave the employees pay for being gone for those reasons that were directly related to the coronavirus. It enables employers to keep their workers on payrolls while at the same time ensuring that the workers are not forced to choose between their paychecks and the public health measures needed to combat the virus. So again, employees that needed to be gone could be paid, and therefore they weren't worried about having to choose between coming to work or getting a paycheck. The Act requires certain employers to provide their employees with paid sick leave or expanded family and medical leave for specified reasons that are directly related to COVID-19, and we'll go through those very specific reasons in a moment. The paid leave provisions are effective from April 1st, 2020, and apply to leave taken between April 1st, 2020 and December 31st, 2020 that's directly related to COVID. This act is administered by the Department of Labor's Wage and Hour Division. So again, the Families First Coronavirus Act requires certain employers to provide their employees with paid sick or expanded family and medical leave for specified reasons related to COVID-19. So there's a few different types of leave that were required to be paid to employees. So the first one is that employees were eligible to have 2 weeks or up to 80 hours of paid sick leave at the employee's regular rate of pay, where the employee is unable to work because the employee is quarantined, and that is due to a federal, state, or local government order or advice from a healthcare provider. So that is not them choosing to self-quarantine. They had to actually be quarantined by a government order or the advice of a healthcare provider, just for clarification on that one. They could also take up to 2 weeks at the employee's regular rate of pay for them experiencing COVID-19 symptoms and seeking a medical diagnosis. As we're all well aware, especially at the beginning of COVID-19, if you did try and get a test, the results were not back immediately. And I believe they're still not back immediately for most people. So if they were experiencing symptoms and they had gotten a test and they were waiting for a diagnosis, that is also a reason that an employer would have been required to pay their employees to be out of work. So here's a big or. So this 2 weeks that we just talked about was 2 weeks or up to 80 hours at the employee's regular rate of pay. Or there could have been another 2 weeks, and these 2 weeks would have been paid at 2/3 of the employee's regular rate of pay. So I want to make sure this 80 hours that we're talking about now, it's the same 80-hour bucket. So it either was paid at 100% of the employee's pay rate or 2/3 of the employee's pay rate, but they didn't get 80 hours twice. So it could have been a combination of the two. It could have been partially paid at 100% of the employee's regular rate of pay, and it could have been partially at 2/3 of the employee's regular rate of pay, but it's the same 80-hour bucket. So I just want to make sure that that's clear. So reasons that the employer would need to pay it at 2/3 of the employee's regular rate of pay as opposed to 100% of the employee's regular rate of pay is if the employee was unable to work because of a bona fide need to care for an individual. And I do have a little bit of information on what an individual is. It's an intermediate family member, roommate, or similar person with whom the employee has a relationship that creates an expectation that the employee would care for the person. So if you're unable to work because you need to care for an individual who is subject to a quarantine, again, that quarantine has to be federally, state, or local mandated by a governmental agency or from the advice of a healthcare provider. Or this person could have been caring for a child whose school or child care provider is closed or unavailable for reasons related to COVID-19. And the definition of a child is biological, adopted, or foster, stepchild, or legal ward, or a child of a person standing in local parentage who is under 18 years old or an adult who is incapable of self-care because of mental or physical disability. So if you had to be out because your child was out of school, you could also be paid at 2/3 of your regular rate of pay. So again, that goes back to this act was designed so that employees could continue to work if they were able, and if they were not able to work directly related to COVID-19, they would still be paid at least at 2/3 of their regular rate of pay. The third reason they could have been paid at their 2/3 rate of pay for those 80 hours would have been the employee is experiencing a substantially similar condition as specified by the Secretary of Health and Human Services in consultation with the Secretaries of the Treasury and Labor. So again, we'll go into those reasons in a little bit more detail in a moment. There was another piece of the FFCRA, and it was the expanded FMLA leave. So this was not available to every single employer, or employee, I should say. A covered employer must provide to employees that have been employed for at least 30 days. So this piece of the act was an additional leave, and it's an additional 10 weeks of paid expanded Family and Medical Leave Act, and this is at the 2/3 rate of the employee's regular rate of pay. This leave was designed for employees that needed to care for a child whose school or daycare was out of commission because of COVID-19 and they couldn't be open. So therefore the employee had no way of having their child cared for, so they needed to take more time off. So this is an additional 10 weeks of pay. So the total amount, if we add the 80 hours that we talked about on the previous couple of slides together with this 10 weeks, it's a total of 12 weeks paid. So employees could take a total of 12 weeks off of work for COVID-related reasons, and those COVID-related reasons vary, and based on those reasons is whether the employee would earn 100% of their regular rate of pay or 2/3 of their regular rate of pay for that time that they were off. So let's talk a little bit more about covered employers. So the paid sick leave and expanded family medical leave provisions of the FFCRA apply to certain public employers and private employers with fewer than 500 employees per the IRS. So when they put out this regulation, they said that if you have over 500 employees, then you do not have to comply with this. A little bit of caveat to that. Most employers of the federal government are covered by Title II of the Family and Medical Leave Act, which was not amended by this act, and therefore they are not covered by the expanded family and medical leave provisions of the FFCRA. However, federal employees covered by Title II of the Family and Medical Leave Act are covered by the paid sick leave provision. Just a little note that I want to point out, because many of us, I'm sure, are Colorado employers. Colorado later issued the HFWA, or the Healthy Families and Workplaces Act, which requires all Colorado employers to provide the 80 hours of paid sick leave. It does not expand to the expanded family medical leave, but it does require the 80 hours. So even if you're in Colorado and you're over 500, which means you don't have to comply per the FFCRA, at the federal level, you do have to comply because Colorado put in the HFWA, which is now requiring that. So I just want to make sure that that is touched on. Okay, so we do have a few employers that could be exempt from the FFCRA, and those are small businesses with fewer than 50 employees may qualify for an exemption from the requirement to provide leave due to school closings and child care unavailability if the leave requirements would jeopardize the viability of the business as a going concern. So they have to be able to prove that before they could be exempted. Also, employers of healthcare providers or emergency responders may elect to exclude such employees from eligibility for the leave provided under the Act. So if you are a healthcare provider and you choose to exclude those employees from the Act, then you do have that option. But I do want to point out again that Colorado passed the HFWA, which doesn't allow you to exempt yourself based on being a healthcare provider. So be a little bit careful if you're in Colorado and you're trying to exempt yourself from the FFCRA. Okay, so let's talk about these qualifying reasons that we've talked about a little bit. Some of them are if they leave for certain reasons, they get paid at 100% of their hourly rate, and others, they only get 2/3 of their regular rate of pay. So let's talk about those reasons a little bit. So under the FFCRA, an employee qualifies for paid sick time if the employee is unable to work or unable to telework because the employee, 1, is subject to federal, state, or local quarantine or isolation due to COVID-19. 2, they've been advised by a healthcare provider to self-quarantine related to COVID-19. And again, I want to point out this is advice by a healthcare provider. This is not advice from themselves telling themselves they want to go ahead and self-quarantine. This has to be from a healthcare provider. 3, they're experiencing COVID-19 symptoms and are seeking a medical diagnosis. 4, they're caring for an individual subject to an order described in 1 or 2 above. So if you have someone who you are caring for that has been subject to a quarantine or has been advised by a healthcare provider to self-quarantine, then you can take time off. 5, you could be caring for a child whose school or place of care is closed, or the child care provider is unavailable for reasons related to COVID-19. And last is experiencing any other substantially similar condition specified by the Secretary of Health and Human Services. So those are the 6 reasons that we talk about, and we're going to talk about them a lot. Okay.
Melissa, we
all right, so Manon.
Sorry, we do have one question. And I don't know, Becky, if this is in relation to the Colorado specific, the HFWA, but it says, is the amount of employees how many you have at the time of the request or at the aggregate of the year? My understanding is
for the
year.
Go ahead, Manon, sorry.
Sorry. My understanding is that if you change your employee count enough that it affects your qualifying reason, your qualification for some of these, then at the point that you have the appropriate number of employees, that's when you start to implement the required leave.
Yeah, I would agree. Okay. All right, so that does bring us up to polling question number 1. So again, just a reminder, when you're answering this polling question, please go ahead and throw your answer into the chat as well as your first and last name so that we can make sure that we know who all has answered the question. So here's my question. Jessica is requesting 1 day off work because her husband has been exposed to COVID-19 and has been subjected to isolation. So my question is, under the FFCRA, which of the following reasons would apply to Jessica's situation? And you don't have to type out that whole reason, just go ahead and put your name and your answer by which number of the reason that you would choose. So I'll give you just a couple seconds to go ahead and answer that. And Manon, if you'll just let me know when it looks like we have a good share of the answers, then I'll go ahead and move on.
Sure, yeah, just 15 more seconds maybe. All right, I think we're ready.
All right, so if you picked number 4, that is what I picked. This person is caring for an individual subject to an order described in number 1 or number 2. All right, so let's take a look at the qualifying reasons for leave for the expanded FMLA. So this is the longer period of time. This is the additional 10 weeks. So the qualifying reasons for leave under the FFCRA that an employee qualifies for is for caring for a child whose workplace or place of care is closed or unavailable for reasons related to COVID-19. So the additional 10 weeks are if your kiddo is out of school or they can't go to whatever child care provider that they have because that child care provider is unavailable or closed due to COVID-19. So that's the expanded FMLA piece, that additional 10 weeks that's paid at 2/3 of the rate. So let's talk a little bit about the durations of the leave. I know we've touched on that a bit, but let's look at it in a little bit more detail directly related to the reasons that they could be leaving. So if an employee requests time off for reasons 1 through 4 or for 6, then a full-time employee is eligible for up to 80 hours of leave, and a part-time employee is eligible for the number of hours of leave that the employee works on average over a 2-week period. So for your part-time employees, they don't actually have to get the full 80 hours. You can look at what hours they work on average over a 2-week period, and that would be what they would be eligible to receive for reasons 1 through 4 and 6 of our list. For reason 5, a full-time employee is eligible for up to 12 weeks of leave at 40 hours a week, and a part-time employee is eligible for leave for the number of hours that the employee is normally scheduled to work over that period. So again, those part-time employees, you would need to look at the average amount of hours that they actually work in a week, and then take that into account when you figure out how much they could actually receive in pay for those 12 weeks. Now, just a reminder, 2 of the 12 weeks are for the sick leave, the sick part of the Leave Act, and the additional 10 weeks is the expanded FMLA, giving them a total of 12 weeks. So that's where we come up with the 12 weeks. So let's look at calculations of pay. Again, we're going to look at this directly related to the reasons that we've already talked about. So for leave reasons 1, 2, or 3, employees taking leave shall be paid at either their regular rate of pay or the applicable minimum wage, whichever is higher. The limits on that are $511 per day, which if you multiply that by 10 working days in a 2-week period, you get $5,110. So that is the limit. So if an employee is making more than that, you do not have to pay them more than that. You could only pay them the total of $511 per day or $5,110 in the 2-week period. If we move on and look at reasons 4 or 6, the employees taking leave shall be paid at 2/3 of their regular rate of pay or 2/3 the applicable minimum wage, whichever is higher, up to a max of $200 per day and $2,000. Again, that's $200 per day multiplied by 10 working days in a 2-week period. And that gives us a total of $2,000 that they could be paid for reasons 4 or 6. The last one, reason 5, again, that's when an employee is out because of that. Their child is out and doesn't have a place to go during the day, whether it's school or childcare. For reason 5, employees take leave shall be paid at 2/3 their regular rate or 2/3 the applicable minimum wage, whichever is higher, up to $200 per day and $12,000 in the aggregate. So over that 12-week period, again, 2 weeks of that is the 80 hours of sick leave with a max of $2,000, and then the additional 10 weeks with a max of $200 per day gives us another $10,000. So if we add the 2 of those together, that's where we get the $12,000 total that can be paid out for the EFMLA portion, combined with the 80 hours of sick leave. So there is some good news for the employers. Most of what we've been talking about previously has been good news for the employees, meaning they could take time off to care for themselves or someone else or a child that's out of school for reasons related directly to COVID. But there is some good news for the employers, and the good news for the employers is that they get a tax credit for paying out this money. So covered employers qualify for dollar-for-dollar reimbursement through tax credits for all qualifying wages paid under the FFCRA. So real quickly, I just want to point out that there are limits that we just talked about under the FFCRA. So the credits that you can take are obviously subject to those limits. So if you're trying to be a nice employer and pay your employees for more than the FFCRA requires, that's really nice of you, but you don't get to take a credit on those additional wages that you would pay. So qualifying wages are those paid to an employee who takes leave under the Act for a qualifying reason up to the appropriate per diem and aggregate payment caps. So that's those limits that we were just talking about. Applicable tax credits also extend to the amounts paid or incurred to maintain health insurance coverage. So you can also take into account the amount that you as the employer are paying out to maintain health insurance coverage for those employees that may be out for reasons related to COVID. But again, remember those limits. So really quickly, let's take a look at at an actual calculation of how we would calculate this on a paycheck. So if this was an employee's paycheck, and I have some temporary sick and temporary family leave earnings that you can see in there. So I just did an example for 1 week. So I did 24 hours of the paid sick leave, and I did 16 hours of the family sick leave. So the 24 hours would be at full rate, and the 16 hours would be at the 2/3 rate. So that is what we, as the employer, paid to the employee. I want to quickly point out that the employer tax does not include Social Security. So Per the Act, these earnings are not subject to employer Social Security tax, which will come into play a little bit here when we calculate the credit. So keep that in mind. These wages are fully taxable for the employee. They're just like normal wages, fully taxable. The employee has to pay all of the taxes on those. So if we take a look at how to calculate the actual credit, we have qualified wages of $589.34. We do not get to take a credit for the employer Social Security tax because, as I just pointed out, and it's in the green box on the screen, the codes themselves, per the Act, are not Social Security taxable for the employer. So we don't get a credit on that because it wasn't taxed to begin with. On the other hand, these wages are subject to employer Medicare tax. So if you look at the calculation, there was $8.55 calculated for the Medicare tax on the $589.34 of the leave that was paid. And so you get to add that into your credit. So if we add those two numbers together, we get a total credit due of $597.89. This is one example for one employee on one paycheck. Cumulative, you would take these and you would add them all up for every employee that you had over the quarter, and you would be able to get a credit back for that. Okay. So to be able to calculate these credits and make sure we're getting all of the credits that we are due, and to tell the federal government how much we paid out in these credits and how much we're due for paying this, they had to revise the Form 941 for reporting. And I'm sure some of you heard my presentation a while back on the new 941. This will not nearly go into as much depth, but I'll show you the highlights. So the revised Form 941 has several new lines on it. Lines 5AI and 5AII are kind of the most important ones. Those are where you actually put down the wages that were paid to the employees. And I will point out that the middle shows that the tax rate that it's being multiplied by on the Form 941 is only 0.062 instead of 0.124. And the reason for that is because, as I pointed out on the last slide, the employer is not responsible for Social Security tax on the wages, only the employee. So that's why it's being multiplied by the 0.062 instead of the 0.124. They also came out with a worksheet 1, which is part of the new instructions for the new Form 941. And the worksheet is intended to help you calculate what credits you're due, what credits you've already been given, and those calculations that you do on worksheet 1 are then put on 2 boxes on the 941, including the bottom line 11B, the non-refundable portion of the credit for qualified sick and family leave wages from worksheet 1. So let's talk a little bit about record keeping and what you have to keep in order to be able to show that you were giving your employees the appropriate leave requested for reasons related to COVID. So regardless of whether you grant or deny requests for paid leave or expanded family and medical leave, you must document the following. Obviously the name, the dates are always a good thing to document, the reason for the leave, and the reason that's so important is because of those 6 reasons that we've talked about so many times, whether it's reasons 1 through 3, where they would be getting their full rate of pay, or whether it's reasons 4 through 6, where they'd only be getting 2/3 of their pay. So that reason for leave is really important. And then a statement from the employee that he or she is unable to work because of the reason that's related to COVID. So those are really important when making sure that you have everything in line, should you ever need to show why an employee was out. If your employee requests leave because he or she is subject to quarantine or an isolation order, or to care for an individual subject to such an order, you should also document the name of the government entity that issued the order. So make sure you understand why they were issued, who issued the order, I should say, to either your employee or an individual that your employee is caring for. And then very similar to that, if your employee requests leave to self-quarantine based off the advice of a healthcare provider, or to care for an individual who is self-quarantined based on, again, advice from a healthcare provider, make sure you document the name of the healthcare provider who gave the advice. So a little bit more on record keeping. If your employee requests to leave to care for their child whose school or place of care is closed or the child care provider is unavailable, make sure you also document the name of the child that is going to have to be cared for or children, the name of the school or the place of care or child care provider that has closed or become unavailable, and a statement from the employee that no other suitable person is available for care for the child. So those are a few additional items that you would need to gather from the employee should they be taking time off for that school or child care provider reason. All right, man, and that brings us up to polling question number 2. So again, remember to put your answer in the chat as well as your first and last name so we can make sure that we get your answers recorded for the RCH credits. So my question is, which form must the qualified sick leave and qualified family sick leave wages be reported on each quarter, beginning with second quarter 2020? And I'll give you a little hint. This form has been revised several times this year.
And just really quickly, it sounds like a couple of people might have chatted on the last answer to just Angela. Make sure that you switch the you switch it to everybody so that I can record that you've answered the question.
Thanks, Manon. Does it look like we have a fair share of our answers for this one?
I think so.
Perfect. All right, if you answered the Form 941, you were correct. And again, that form has been revised several times this year, and I think we'll see it revised several times again based off of all of the changes that are still occurring. So that's a lot of information about the FFCRA, or the Families First Coronavirus Response Act. So let's put that one on the back burner for a moment and let's talk about the other one, which is the CARES Act. So the CARES Act is the Coronavirus Aid, Relief, and Economic Security Act. It was passed by the Senate on March 25th, 2020, and it was signed into law on March 27th, 2020 by President Trump. The intent of the CARES Act was over $2 trillion economic relief package committed to protecting the American people from the public health and economic impacts of COVID-19. The CARES Act provides fast and direct economic assistance for American workers, families, and small businesses, and preserve jobs for American industries. That was the intent. So the CARES Act aids workers and their families in a few different ways. We're going to talk about those different ways. So the first one is there was economic impact payments to American households of up to $1,200 per adult for individuals whose income was less than $99,000 or $198,000 for joint filers, and $500 per child under 17 years old. The total was up to $3,400 for a family of 4. So those were the economic impact payments that were received directly from the IRS as part of the CARES Act. The second thing the CARES Act did is it creates an employee retention credit, or an ERC, for employers that have been forced to shut down operations or that have experienced a significant decline in gross receipts on account of the coronavirus. Number 3, the Act allows employers to delay payroll tax deposits until the end of 2021 and 2022, and that is for the employer Social Security tax. And we'll talk more about each of these. So, number 4, the CARES Act established the Paycheck Protection Program, or the PPP loan program, which I'm sure many of you are super familiar with. And again, we'll go into each of these in more detail here momentarily. So number 5, it has enhanced unemployment benefits, and let's look at each of these individually. So the first one is the economic impact payments. Again, tax filers with adjusted gross income up to $75,000 for individuals and $150,000 for married couples filing joint returns will receive the full payment. For filers with income above those amounts, the payment is reduced by $5 for each above 100, for each $100 above the 75,000 and 150,000 thresholds, but they will still receive some payment. Single filers with income exceeding 99,000 and 198,000 for joint filers with no children are not eligible, so they did not receive anything. Social Security recipients and railroad retirees who are otherwise not required to file a tax return are also eligible and will not be required to file a return. Eligible taxpayers who filed tax returns for either 2019 or 2018 will automatically receive the economic impact payment of up to $1,200 for individuals and $2,400 for married couples and up to $500 for each qualifying child. So that was the economic impact payments, which weren't really directly related to payroll, but they did help the individuals throughout this crisis. So something that is very applicable to payroll is this employee retention credit, or the ERC. The credit is available to all employers regardless of size, including tax-exempt operations. There are only two exceptions to this, and it's state and local governments and small businesses who take the small business loans, or the PPP loans. So what's really important to understand right here is that many companies took the PPP loans, and once you took a PPP loan, you were not eligible for the employee retention credit. You could not have both. So in my experience, the employee retention credit has been talked about much less than the PPP loans, and that's because many businesses took the PPP loan and thus were not eligible for the employee retention credits. But if you didn't take a PPP loan and you are not state or local government, you could be eligible for the employee retention credits. But you have to be a little bit careful, because in order to qualify, you must fall into one of two categories. One, the business is fully or partially suspended by government order due to the COVID-19 pandemic during the calendar quarter. Or two, the employer's gross receipts are below 50% of the comparable quarter in 2019. Once the employer's gross receipts go above 80% of a comparable quarter in 2019, they no longer qualify after the end of that quarter. So in order to qualify for the ERC, you have to show a significant decline in gross receipts. And you have to continue to show that in order to continue to be able to take the ERC credit. And once you go over the 80%, you are no longer eligible. So let's look at the actual credit that would be available for an employer that was going to be eligible for the ERC. The amount of the credit is 50% of qualifying wages up to $10,000 in total per employee. The wages that are eligible must have been paid after March 12th, 2020 and before January 1st, 2021. Wages are not limited to cash payments, but can also include a portion of the employer-provided health care. So again, there's still that $10,000 limit, but you could use health care as well as wages to come to that limit. So for the qualifying wages are based on the average number of a business's employees in 2019. If your employer with less than 100 employees, then the credit is based on wages paid to all employees, regardless of if they worked or not. If the employees worked full-time and were paid for full-time work, the employee still receives the credit. On the other hand, if the employer had more than 100 employees during 2019, the credit is allowed only for wages paid to employees who did not work during the calendar quarter. So let's look at how we would actually calculate a credit for the ERC. So here's a list of wages that were paid during the second quarter. We look at the total wages, and we paid a total of $138,852.50. That's our total wages for second quarter that were paid to all of our employees. If we look at the second column that says total qualified wage, that's the qualified wages for second quarter, which is after the 50% reduction and the $10,000 maximum in wages. So as you can see on that first pay date, 4/3, all of the wages were qualified. That's because the employees had not hit that $10,000 limit yet, But as we move further down in the quarter, the qualified wages are becoming less and less and less, and that's because those employees are hitting that $10,000 wage limit. So once you calculate your qualified wages, you would be able to put your credit onto line 21 of the Form 941, which is the qualified wages for the employee retention credit. Once we've calculated the credit, we actually need to receive the credit. So how can we receive the credit? The most easiest way and the best way for the IRS was employers can be immediately reimbursed for the credit by reducing their required deposits of payroll taxes that have been withheld from employees' wages by the amount of the credit. So you could reduce your payments to the IRS for amounts of your employee retention credit and just not pay them to the IRS. That was the quickest way to get that money back in your account as the employer. Eligible employers will need to report their total qualified wages in the related health insurance costs for each quarter on the quarterly tax return, which again is that Form 941 that we've already looked at. And then if an employee or an employer didn't reduce their payments by the amount of the employee retention credit that they were due, they could also submit a Form 7200 to request that money back from the IRS. So there was a few different methods of being able to get your employee retention credit back. So another thing that the CARES Act did was the payroll tax deferral. The intent of this was to enhance cash flow so that businesses can better maintain operations and payroll. Employers and self-employed individuals can defer payment of the employer share of Social Security tax. I want to point out that this is the employer share of the Social Security tax. This is not the tax holiday that we're going to talk about shortly, which is related to the employee share of the Social Security tax. The payroll tax deferral that was part of the CARES Act was the employer's share of Social Security tax. So the CARES Act said that employers could defer payment of that, the employer's Social Security tax, and it can be paid over the next 2 years. And if paid in full by December 31st of 2022, they would avoid penalties and interest. Half of it must be paid back on December 31st, 2021, and the remaining amount must be paid back by December 31st of 2022 in order to avoid any penalties and interest. Originally, this was not allowed to be taken if you had a PPP loan. That was later changed when the Flexibility Act came out, and now all employers can take advantage of this should they choose. But again, it is a deferral. It is not a forgiveness. So you can defer payment, but you still do owe it. It's just at a later time. Again, this amount must be recorded on our new fancy 941. It happens to go on line 13B. All right, polling question number 3. And again, your name and your answer, and don't chat just to Angela, chat to everybody. And I'm going to be mean and I'm going to ask you to do math, but I'm going to tell you it's easy, so don't overthink it. My question is, if your company chooses to defer the payment of employer Social Security tax and you have accumulated $50,000 in deferred taxes as of today, how much will be due in December 2020? Again, that's December 31st, 2020. How much of the taxes are due?
Melissa, we do have a question for you before you move on as well.
Okay.
And everybody is getting really quick at answering.
Okay. All right, well, I hope I didn't get too tricky on them, but the answer to this was actually 0 because the first installment would not be due until December 31st of 2021, and I asked what was due 2020. I know that was mean.
Okay,
All
so
right, Manon,
before
what's
we
your
move
question?
on, yeah, thank you. So a
Yeah.
question is, if you didn't calculate this credit, the ERC credit, because you were told you didn't qualify as your over 500 employees, can you revise your second quarter 941 to get the credit?
I would say that I don't have the best answer to that. I will tell you that the IRS did not release the new amended Form 941 until last week, and I haven't had a chance to dive into that one really quickly yet. So I have not looked at the amended Form 941 to see if you would be able to revise it, but my first thought is yes. So Manon, can you make a note and we can do a little research and make sure that I have a good answer on that one?
Sure.
Perfect.
All right, that's all from us.
Perfect. All right, so let's take a quick look at the Paycheck Protection Program. I'm not going to do a whole bunch on this one just because this has been talked about a lot, and there's been many webinars on this one, so you guys have heard a lot about it, I'm sure. But the basic premise of it is the Paycheck Protection Program provided small businesses with resources they needed to maintain their payroll, hire back employees who may have been laid off, and cover applicable overhead. It was implemented by the Small Business Administration with support from the Department of Treasury. It was to provide funds for up to 8 weeks, which was later changed to be either an 8-week or a 24-week period of payroll costs, including benefits. Funds could also be used to pay interest on mortgage, rent, and utilities. So the government basically gave money to try and keep everybody afloat throughout the pandemic and try to keep employees employed. Small businesses and eligible nonprofit organizations, as well as veteran organizations and tribal businesses described in the Small Business Act, as well as individuals who are self-employed or independent contractors, are eligible if they meet the program size standards. So funds were provided in the form of a loan, and that loan will be fully forgiven as long as it is used appropriately for payroll costs, interest on mortgage, rent, and utilities, and you can prove that it was used as such. Forgiveness is based on the employer maintaining or quickly rehiring employees and maintaining salary levels. Forgiveness will be reduced if full-time headcount declines or if salaries and wages decrease. So the whole purpose of this PPP protection program was to get employees back to work if they had been laid off, or keep employees working if they had not yet been laid off. So if you did not bring employees back, or if you had reduced salaries, then the forgiveness amount would be reduced and it may not have been fully forgiven. All right, so the last thing we're going to look at for the CARES Act is the unemployment benefits that were enhanced during the pandemic. So the first piece is the Pandemic Emergency Unemployment Compensation, or the PEUC. The CARES Act builds on existing state unemployment insurance programs by providing PEUC to those who have exhausted benefits under state programs for up to an additional 13 weeks of benefits. So this expanded benefits if an employee had exhausted their benefits under the state programs. The Federal Pandemic Unemployment Compensation, or FPUC, provides an additional $600 to an employee's regular UI benefit for weeks of unemployment through July 31st of 2020. And then the last one is the Pandemic Unemployment Assistance, or the PUA. And this provides benefits for self-employed individuals, those seeking part-time employment, and others who would not qualify for regular UI benefits because they're not a regular employee. So those are the enhanced benefits that were part of the CARES Act for unemployment. So let's quickly put it all together. Let's look at the FFCRA and the CARES and how they benefited employers as well as individuals. So for employers, they were required to pay leave under the FFCRA, and that leave had to be directly related to COVID-19. But they were eligible to receive tax credits for both that FFCRA paid leave that we just discussed, and also there was that tax credit from the CARES Act that was the employee retention credit. So there were some tax credits available to the employers for some relief. There was also the payroll employer Social Security tax deferral, which came from the CARES Act, meaning employers could defer the payment of the employer Social Security tax until the end of 2021 and 2022 to be paid in full by the end of 2022. And the PPP loan was part of the CARES Act as well, which was intended to help employers keep their employees and keep them in business during the pandemic. As far as individuals, they were able to take paid leave and EFMLA as part of the FFCRA. Again, that leave had to be for COVID-related reasons. They also received the economic impact payment if they were eligible based off of their 2019 or 2018 tax returns. That was part of the CARES Act. And then there was the enhanced unemployment benefits, which was part of the CARES Act as well. So for those employees that were out of work because of the COVID-19 pandemic, there was a little bit of extra relief for them for unemployment. So what else? This is just something I wanted to touch on because I know it's a hot topic right now. The payroll tax holiday, as some are calling it. So on August 28th, the IRS issued Notice 2020-65, which allowed employers to suspend withholding and paying eligible employees' Social Security payroll taxes as part of COVID-19 relief. President Trump sent a memorandum on August 8th to the Treasury Department to defer collection of the employee portion of Social Security from September 1st through the end of 2020. The payroll tax holiday or suspension period runs from September 1st through December 31st and applies only to employees whose wages are less than $4,000 for a biweekly pay period, including salaried workers earning less than $104,000 per year. Companies that suspend collection of employees' payroll tax would collect additional amounts from workers' paychecks from January 1st through April 30th next year to repay that tax obligation. So it's a deferral. It's not forgiven. The employees still owe the tax. Should the employer suspend the collection, they will have to collect additional amounts from the period of January 1st through April 30th next year to make sure that the tax obligation is paid in full. So employers that suspend collection of eligible employees' Social Security payroll taxes during the 4-month suspension period must repay the deferred taxes to the IRS during the first 4 months of 2021. If they do not pay it all back before April 30th of 2021, penalties, interest, and additions to tax will begin to accrue on employers for tax amounts that have not been repaid according to the guidance. So what's really scary about this, this memorandum is those employees that leave before the taxes are repaid. And that's the fear of businesses to start doing this deferral on behalf of the employee is what happens if an employee leaves before the taxes are repaid. And unfortunately, the guidance is not incredibly clear on that. But what we do know is the employer remains liable for the employee's share of Social Security taxes. The due date is just extended to next year according to the guidance. The guidance also says that the employer may make repayment arrangements with the employee, such as deducting that amount from their final paycheck. Otherwise, the employer would have to pay the balance owed. So as an employer, it's a little bit nerve-wracking to go ahead and implement that because there isn't a lot of guidance on if the employee leaves before that amount is paid back, then who does the liability fall on? And at this point, it looks like it's falling on the employer. So you just want to be really, 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 really careful when thinking about whether or not to do this, that you think about the consequence of that. It would also be important to make sure that if you do take this and think about doing it, that there is something in writing from the employee that says that if they terminate, that you're going to collect the amount of Social Security tax that's been deferred from their final paycheck. And you have to be careful with state laws and things like that to make sure that that is actually allowed. So we just really want to make sure that you're checking with your lawyers and your accountants to make sure that that's something that you want to step into before you do it. So really quickly, the payroll tax holiday reporting is still a little bit unknown at this point because it's still very, very new. They do have another draft form of the 941 out, and they have changed one of the current lines on there line 13B, which I referred to earlier in a slide that said deferred amount of employer Social Security tax. And you'll now notice the word employer is gone from that line. So this revised Form 941 looks like we may have just a deferred amount of Social Security tax, which could include both the employee as well as the employer tax on that line. It also looks like we may have to have revised Forms W-2 for 2020 because we would need to record how much was deferred from the employee during 2020. And then we would also need to record somehow the repayment of that on the Form 2021 W-2. So there's, again, still many, many, many questions, way more questions than answers at this point on the payroll tax holiday. But I did want to touch on what we kind of know at this point, and we're waiting on more guidance from the IRS and the Treasury on how exactly to implement that, and that's where we're at. So that is what I have for you. I know Manon's been keeping track of questions as we go, but is there anything I missed?
We did not have any other questions come in. Do we have any other questions now for Melissa? Okay, well, keep an eye on chat to see if any more come in, but thank you all for joining us today. I hope this was helpful for your knowledge on all of the changes that we've been having this year, some of them anyway. Melissa, thank you. You did fabulous. That was so much information to cover in a short amount of time, so thank you for taking it through all of that. Next month, we actually have our scheduled presentation is going to be from Rebecca, and that's going to be focused on the HFWA, so that Colorado-specific legislation that came out. So we hope that you will all be able to join us for that. And again, we're hoping we're going to get that as a RCH credit as well. So thank you all for joining us again. If you are interested in participating on a committee, particularly that welcome committee, we would really, really appreciate it. Just reach out and let us know. It doesn't take too much of your time, and it's a great way to start getting to know other chapter members and just to grow our chapter in general. So thank you.
Yes, I'll reiterate that. Thank you all for joining us today. And our next meeting will be on, let me grab my calendar. Next meeting will be October 21st. And again, we will send out reminders as we get closer. Thank you, Melissa. That was an excellent presentation. I've been jotting down notes and everything. I really, really appreciate your preparation for this today. Thank you all for joining us, and we will send you out the RCH certificate just as soon as it is, we get, is it after it goes through the APA and we get it, no?
I can send it out today, and it will be by email.
You can send it out today?
Yes.
Okay. All right, so look for it in the mail.
Email.
Or email. All right, thank you all. I appreciate your joining us today, and have a great rest of the week.
Thank you.
Thank you, Becky, and thanks, Manon, for helping me with this presentation.